After studying this module, you shall be able to understand the need to measure national income, define gross domestic product, depreciation, and net indirect taxes. Identify the circular flow of income and expenditure in an economy, and finally learn that output, income, and expenditure are always equal in an economy.
Hello students, I am Suresh Agarwal, Professor in the Department of Business Economics, South Delhi campus, University of Delhi. The extent of a nation's wealth has always been keenly followed by economic policy makers. In the 17th and 18th century, the mercantilist measured the stock of a nation's wealth by a stock of precious stones and metals. It was the Great Depression of 1930s that emphasized the need to design comprehensive measure of national output and income. The empirical measurement of a nation's aggregate economic activity and growth began with the work of one of the most important Nobel Prize winning economists, Simon Kuznets and Richard Stone, in 1931 while working on the US national accounts. The national income accounting is basically based on defining certain aggregate measures like GDP, GNP, and other related measures like personal income, personal disposable income, and then measuring them. These measures basically enable us to study the growth of an economy and working of business cycles that may be of interest to policymakers, to businessmen, and to many others. It mainly characterizes an economy providing insights into why and how some nations are able to enjoy higher standards of living than others. It also provides the basic ingredients for models used in macroeconomic theory. For instance, division of output into several components such as consumption, investment, government expenditure, and net exports enables the study of aggregate demand, which is very important in macroeconomics. The presence of accurate data enables testing theories as well as predicting future events and trends. The present module will outline several important concepts and issues involved in measuring the economic activity of a nation using the framework of national income accounting. The knowledge of these accounts is indeed an important first step in understanding the complex working of several sectors and their interrelationships in a macroeconomy. The business cycles and consequent economic conditions in an economy concern all of us through incomes, inflation, unemployment, foreign exchange, or trade. Therefore, in this module, some concepts that are used to measure an economy's performance are explained to you. But before these are introduced, it is important to understand the concept of GDP in an economy, which is one of the most important concepts.
The Great Depression of 1930s emphasized the need to measure national income. The national income is measured using comprehensive accounts of economic activity in a country. Such a measure is of great interest to policymakers as it helps in taking informed and calculated steps. It helps in studying growth of economy and other variables such as GDP and GNP. It also facilitates the understanding of business cycles. Now let us define the terms GDP and GNP. GDP is aggregate measure of all currently produced final goods and services evaluated at market prices within the nation's domestic territory during a specified period. GNP, on the other hand, is based on contribution made to flow of goods and services by its residents only. GNP includes income earned abroad by Indians but excludes income earned by foreign residents in India. In other words, GNP is GDP plus net factor income from abroad.
It is important to distinguish between final and intermediate goods here. What is an intermediate good? An intermediate good is one that is used in the production of other goods in the same period for any kind of processing and is then resold. Similarly, we may define a final good as one when the product reaches the final stage of consumption. Whether the transaction is to be classified as intermediate or final, therefore depends on who buys and what is the purpose. For example, potatoes used for making a meal by a consumer is a final good. However, if they are purchased by a firm to manufacture potato wafers, then it becomes an intermediate good. Intermediate goods are not added to GDP as their value is already included in the final good. Counting them again would result in double or multiple counting. For example, if both the value of potatoes used in making wafers and potato wafers are included in GDP, or if both of the value of steel used for producing cars and car is included in GDP, then this would exaggerate the GDP figures because we would be counting either steel twice, both in car as well as steel separately, and similarly for wafers and potatoes.
Some of the important aspects of the definition of GDP that need special emphasis are final goods and services. Goods and services are of two types, intermediate and final goods. It is only the final goods and services and not intermediate goods that are a part of GDP. While computing GDP, only final goods are calculated and are included and their values added together. Another is value added at each stage of production. The value added method computes GDP by adding the value added in the economy. The value added is defined as value of total production less the value of intermediate inputs used in production. To avoid the problem of double counting, value created at each stage may be added. Third, important aspect is currently produced goods and services. As you must be aware, GDP includes only the currently produced goods in a particular period. Accordingly, transactions involving exchange of previously produced goods such as houses, automobiles, etc. are not a part of current GDP. However, services of second-hand dealers and brokers are a part of GDP as their service provides utility in the current period. Final one is goods are evaluated at their market prices. It would not be possible to directly compare two entirely different kinds of products or services. For example, in a hypothetical economy that produces a kg of an apple, a haircut, it would be difficult to measure the total economic activity. However, if we multiply these quantities by their prices, the value of these final goods and services can be added together.
A problem of measuring at market value is that the goods that are not sold in the market fail to be included in GDP because we do not know their market price. The most important ones are services of housewives, all activities done at home such as child care, cooking, cleaning, etc., or produce from kitchen, garden, etc. So though these are productive activities, but the question is how do we include them in the calculation of GDP? Because unless we know their prices, it is very difficult to find out and include them in the calculation of GDP. Therefore, in addition, the output from non-reported activities besides these household activities to avoid payment of tax or illegal activities such as gambling, prostitution, drugs, etc., is not necessarily a part of GDP because of valuation of these activities. These will be discussed later on again in this module. Let us therefore start by understanding and what is a stock and what are flows. So let us try to understand the difference between stocks and flows. It must be observed that some variables are measured at a point of time while others are measured over a period of time. For example, saving is measured over a period of time. Higher savings leads to greater wealth accumulation, which is measured at a point of time. Therefore, saving is a flow, whereas wealth is a stock. The variables which are measured at a point of time are known as stock variables, such as wealth, assets, capital, stock, etc., while those that are measured over a period of time are flow variables such as GDP, income, expenditure, etc. And in this context, therefore, it needs to be clarified that GDP attempts to measure economic activity undertaken in a particular year in an economy. So GDP is a flow because it is measured over a particular year. It does not attempt to measure national wealth or stock of assets a nation possesses, which is measured separately by national capital.
Let us now go through certain useful concepts that will be used throughout the course. First is to clarify the distinction between stocks and flows. The variables that are measured over a period of time are flow variables such as GDP, expenditure, income, etc., while those which are measured at a point of time are stock variables such as wealth, assets, capital stock, etc. Next is distinction market price and factor cost. The value of final goods and services that is measured at market prices is GDP at market prices. However, the GDP at factor cost differs due to existence of indirect taxes and subsidies. In order to derive the actual cost, net indirect taxes are subtracted from GDP at market price. The difference between gross and net is depreciation. Depreciation or consumption of fixed capital is the capital that is used up or wears out during the production process. This depreciation is subtracted from gross GDP. Next is distinction between domestic and national products. The difference between the two is net factor income from abroad. GDP is obtained by subtracting NFI from GNP. GDP per capita is country's GDP divided by country's population. That is, GDP per capita is equal to GDP divided by the population. We have just learned that domestic and factor incomes vary if net factor income from abroad is large. Such an economy is open economy. However, in certain cases the economy may be closed to other countries by means of various trade and capital restrictions. Such are called as closed economy.
Once we have understood what is GDP, let us now try to understand what is per capita GDP. It is important to recognize that a higher national income of a country does not necessarily translate into higher standards of living for its citizens. A high national income could result into lower standard of living for citizens if the population of a country is increasing faster than its income. In this case, one could say that the national pie or the cake is distributed between larger number of people, resulting in lower share for each individual. Therefore, the concept of per capita income becomes relevant as it takes into account the size of population and generally therefore is defined as GDP divided by population and is known as GDP per capita. That is therefore a formula which we can also write down here. GDP per capita is equal to GDP divided by population. In a similar manner, GNP per capita can be defined as GNP divided by population. The difference between GDP and GNP is more significant in a relatively more open economy. Let us now discuss the distinction between open and closed economies. The distinction is quite straightforward. An open economy is one that is having trade relations with other countries of the world. And therefore, on the contrary, a closed economy is one that does not trade with other nations and is just concentrated on domestic production and domestic consumption. However, in today's world, the concept of closed economy is unrealistic, as all modern economies are open, though they may have different trade sanctions or trade restrictions like quotas and other tariff and non-tariff barriers. Therefore, the assumption of closed economy is often made in macroeconomic models for the sake of simplicity, just to understand a simplified macroeconomic model. But to make the then to make the analysis more realistic, open economies are considered. And therefore, in the next section, we will try to understand this circular flow of income and expenditure which takes place in an economy based on the assumption of first a closed economy and then in an open economy. Slide before animation. Let us now move our attention to circular flow of income and expenditure. By evaluating an individual's income, a lot can be learned about his standard of living. But the expenditure statement of the individual is also likely to give us a good idea of individual's standard of living. Just as both income and expenditure provide valuable information of an individual's living standards, a nation's standard can be judged using its aggregate income and aggregate expenditure. The circular flow of income and expenditure is basically a pictorial representation indicating this equality. You will find and understand that how the income and expenditure flows are equal. The circular flow therefore demonstrates critical interlinkages in an economy that arises in the process of interaction among economic agents. In a closed economy, the agents are firms, households and the government, and in a simple two-sectoral model, households and firms are the only two agents. Government, generally we assume in a two-sectoral model, is missing initially. Of course, the model can be made more realistic by enhancing the level of complexity and incorporating later on governmental sector, external sector, financial sector, and instead of just the real flows, we can also have the financial flows, which means the monetary flows. However, the basic point can be put across more effectively using, in the beginning, a two-sectoral circular flow of income. This model shows the transactions that arise between household and firms in a closed economy. In such a model, production is carried out mainly by firms. The firms produce various goods such as intermediate products, final goods, investment goods, and services. The intermediate and final goods have already been discussed. I am sure now you would be very clear about the distinction between intermediate and final goods. The investment goods are sold to firms while final consumption goods are sold to households. In this process of production, we basically use different factors which are labor, land, capital and entrepreneurship, which provide their services to produce these goods. In the modern world, we generally try to reduce these four factors into three factors: land, labor and capital, especially in modern corporations where entrepreneurs are also treated like labor or hired labor. These factor services are provided by households, mainly the labor, capital and land, because they are supposed to be the ultimate owners of all these factors of production.
The circular flow of income and expenditure is a pictorial representation indicating the interlinkages in an economy that arise in the process of interaction among economic agents. In a simple two-sector model, households and firms are the only two agents. In such a model, production is carried out by firms. The factor services such as labor, capital, and entrepreneur are provided by households. The real flow of factor services from household to firms is depicted by R1 in the figure. The firms in turn make payment for their factor services in the form of wages, rent, and distributed profits. These monetary flows in this simple two-sector model, GDP is equal to Y, which is equal to C plus I, where C represents current consumption and I, investment. Y is also equal to C plus S, as in a closed two-sector economy, saving enables economy to produce goods for investment. Adding government in above scenario, GDP is equal to Y, which is equal to C plus I plus G, where G represents government expenditure. It also equals Y is equal to C plus S plus T, that is, aggregate income is either consumed.
However, we can see here now that though GDP measures the national income of a country, however, it has limitations as a measure of social welfare. So what we are trying to say is GDP is goods and services, but can it be used as a measure of welfare of the people of a country? The answer we are going to provide just now. Till date, GDP is most comprehensive measure of nation's production capacity. The real GDP may be the best measure of evaluating an economy's production capacity, but still this GDP per capita would account for both inflation and population stock of an economy, and therefore it has several limitations. The first limitation is that GDP measures market value of all goods and services produced in an economy during a year. However, it does not give any significance to the composition or the kinds of goods which we are producing. So suppose in a year we are producing more of luxuries in an economy, it would indicate that the market caters to the demand of richer sections. This also indicates that there are wide inequalities of income and wealth in such an economy because these luxuries are consumed by richer sections and not by poorer sections of the society. It does not therefore give any importance to layer, which certainly would make a work-burdened individual better off. As an individual grows richer, he is likely to allocate more hours to layer than work. But the measure of GDP fails to account for higher availability of leisure time, resulting in much greater utility for its individuals. Similarly, all activities performed at home are not part of GDP. It is indeed strange that a mother taking care of a child leads to no addition to GDP, while a nanny taking care of the same child adds to the GDP of a nation. In this sense, GDP underestimates a lot of productive activity in the economy, especially of women. This is not because housework is unproductive, but because these activities are not sold in the market and we do not know their price. Hence, it is difficult to assign value to them. And unless we assign value to them, they cannot be included in GDP. The government, in its pursuit of meeting the objective of social equity and welfare, may sell the products at a price much below their cost. For some goods such as defense, roads, public education, there may not be any market at all. And in computation of GDP, therefore, these services are also underrepresented, as due to lack of working of proper markets, government services are valued at their cost and not at their market price. Further, some economic activities add to environmental degradation, adversely affecting the nation's welfare. These activities have resulted in global warming, and many other kind of problems, which could be air pollution, which could be water pollution, and so on. I am sure all of you are aware about these environmental hazards which some of the economic activities are producing in our countries. Therefore, in the computation of GDP, no such calculation is done to subtract the cost imposed on those not involved in these transactions by this negative externality. It does not account for environmental damage caused in the process of increasing economic growth. Surprisingly, national income accounting considers depreciation of physical capital but does not consider the depletion of natural resources such as oil, fish, soil, forest, fertility, etc., some of which are getting exhausted. The measure green GDP accounting makes downward correction to GDP to take these social costs into account, and therefore green GDP has become a very buzzword in the today's parlance. In the wake of rapid technological progress, there is a continuous change in the quality of existing goods. For example, computers, smartphones, automobiles today are much different than what they were few years ago. I am sure you are all using these products and you would be aware how they are different today. It is, however, difficult to account for the changes in the quality of various goods in GDP over time. How do you account for these changes in quality except their market price? But do these market prices reflect the true differences in the quality also? That is a question which we have to understand and ponder over. In sum, we may say that though there are several limitations associated with this measure of aggregating a nation's income, yet it continues to remain the best and most widely used measure of welfare and standard of living till we get an alternative, better measure of national welfare and people's standard of living.
GDP has several limitations. GDP does not give any significance to composition or kinds of goods produced. If more of luxuries are produced in an economy, it indicates that the market caters to rich section. Therefore, there are wide inequalities of income and wealth in such an economy. It does not give any importance to leisure, which certainly could make a work burdened individual better off. For many activities, markets are missing. Due to absence of market transactions in many cases, such as clean air or pollution, it is difficult to incorporate these transactions in GDP. Housework are ignored in GDP. It is indeed strange that a mother taking care of her child leads to no addition to GDP, while a nanny taking care of the same child adds to GDP of a nation. Government, in its pursuit of meeting the objective of social equity, may sell the products at price much below their cost. In computation of GDP, government services are underrepresented due to lack of working of proper markets. Some economic activities add to environmental degradation, adversely affecting the nation. In the computation of GDP, no such calculation is done to subtract the cost imposed by this negative externality. The measure green GDP accounting makes downward correction to GDP to take these social costs into account. Finally, in wake of rapid technological progress, there is a continuous change in the quality of existing goods. It is difficult to account for these changes in quality of various goods in GDP over time. To summarize, we studied different reasons to measure national income, learned the definition of GDP and GNP, identified important aspects related to GDP such as final goods and services, value added at different stages of production, etc., studied conceptual issues with GDP such as stocks and flows, distinction between gross GDP and net GDP, difference between GDP and GNP, etc. Also studied in detail about circular flow of income and expenditure, and finally covered the limitations of GDP.
So let us now try to summarize and learn what we have, or try to summarize and see what we have learned in this module. I am sure there are some takeaways from this module for all of you. The first, I may say, is the empirical measurement of a nation's aggregate economic activity and growth began with the work of Nobel Prize winning economists Simon Kuznets and Richard Stone in 1931 while working on US national accounts. I am sure you would agree that the second takeaway has been that the knowledge of national income accounts is indeed an important step in understanding the complex working of several sectors and their interrelationships in a macroeconomy. The two aspects, income or output and expenditure of the GDP measures, are reflected in circular flows of income and expenditure. And as I said earlier, income flows and expenditure flows are equal. However, there are leakages and injections taking place from circular flow of income, which one can and one must have noticed from our earlier discussions and diagrams, where we have seen that the GDP of a nation is an aggregate measure of all currently produced final goods and services which are evaluated at market prices within the nation's domestic territory during a specified period. And that is how we said it is a flow concept, not a stock concept. We have also learned that intermediate goods are not added to GDP as their value is already included in the final goods, and only final goods are added to avoid multiple counting, because otherwise our GDP would be inflated. So to avoid the problem of double counting, value created at each stage may be only thing which may be added. Adding the value added at each stage will result in total value of the final product. And this method is also defined as value added method. Using the income method, GDP can be measured as the sum of incomes generated in an economy. I am sure students, you also must have noticed how we have tried to differentiate between the concept of GNP and GDP, and we have tried to learn also the difference between the other few important concepts, where GDP is net factor income from abroad, and if you add the net factor income from abroad in GDP, you get GNP. So let me repeat, the difference between GNP and GDP is net factor income from abroad. Similarly, we have also seen that an allowance for capital consumption during the year has to be made to reflect the usage and wear and tear of capital, like as we exclude intermediate products. Similarly, we have to exclude this capital consumption during the year from our GDP. So to arrive at gross national income at factor cost, indirect taxes needs to be subtracted while subsidies needs to be added, because then we will get the national income at factor cost. Till date, GDP is, as we have mentioned earlier, is the most comprehensive measure of nation's production capacity. However, as we have earlier also learned, that it has several limitations as a measure of standard of living and welfare. But till we get a better alternative, we continue to use GDP per capita as the measure of national welfare or people's welfare. Thank you.